Hmm. Hello and welcome back to the class. In today's class, I'm going to record the chapter by chapter quizzes for chapter 1, chapter 2, and for chapter 3. If you have not yet watched the video recording of the entire chapter by chapter that I have done, I will recommend you do so first before you jump onto the quizzes. And in the quiz, I'm going to try my best to explain the question, the options of the answers provided, and the right answer. So, as usual, let's dive into it. Now, I will be sharing my screen. So, in this question, when I think each chapter by chapter quizzes gives you 10 questions that you're expected to answer. Okay, so look at it here. Question number 1. Which estate objective is when a person with children might say that he wants to make sure that his children can go to university or college even if he dies, right? Number 1, charitable giving. So to explain the question, like this is just explain which estate objective. In other words, when we start talking about estate, this is the planning for when somebody is no more. Okay. Now, what kind of estate objective it is when somebody wants to make sure that his children can go to school or college, even when he or she dies? Option A, charitable giving. No, it can't be charitable giving because charitable giving is not going to ensure that your kids go to school. Estate creation. Estate creation talks about keeping some real estate, some estates, how do I put this? So ownership of some real estate stuff within the estate, okay? Education funds and legacies. I believe it would be education funds, okay? So I'm going to go with education funds. Let's go to the next one. We'll see moment of truth if that's correct or not, okay? What risk strategy is described as simply deciding not to expose oneself to the risk in the first place? Yeah, remember we thought about this. We thought about this when you decide not to expose yourself to the risk in the first place. What kind of risk strategy is that? Is it risk retention? Nah. Is it risk transfer? No. Is it risk reduction? No, it is risk avoidance. You avoid risk when you choose not to expose yourself to the risk. Okay, we'll discuss simply deciding not to expose. Remember when during the course we talked about smoking, choosing not to smoke because of the risk that comes or associated with smoking. Got it? All right. If you don't, go back and watch the video again. That is in the recording of chapter 1 and chapter 2 together. And in the future, I'm going to try to maybe do a separate chapter by chapter recording. All right. Moving on. Question number 3. What liability arises upon death that can seriously erode an estate? Ooh. I remember during this training, I said that even dead people pay taxes. Remember I said that, right? Anyways, option A, income taxes, no. Loss of caregiver, no. Loss of income. Is it loss of income or debt repayment? Mm, 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 mm. What liabilities arises upon death that can seriously erode an estate? Is debt repayment, because there will be debt that will be triggered upon the death of an individual. Okay. Okay. So moving on, question number 4. When a person dies, which one of the financial impact causes the executor of the estate to pay off any outstanding debt, including mortgages, car loans, and credit cards debt. Ooh, income taxes, debt repayment, loss of income, loss of caregiver. Wow, when a person dies, which one of the financial impact causes the executor of the estate to pay off any outstanding debt, including mortgages? It should be debt repayment, I believe. I might be wrong. I don't know everything, guys. So we're going to see the answers at the end. So just let's ride along. All right. And you know what? Maybe they've changed this thing. Okay, let's answer this one and see. Which death of the non-income earner, which death of a non-income earner can have a significant impact on the surviving family's finances, particularly if the deceased took care of the family's children or other dependent family members? Yeah. Number one, option A, income taxes. Option B, loss of income. Option C, debt repayment. Option D, loss of caregiver. I believe is option D, loss of caregiver. You see, this death of significant of this non-income earner, even though this particular um, partner is not the income earner, right? But the impact of her disease or his disease will be felt significantly because of other stuff that he or she does within the family. Okay. So yeah, so we'll move to the next. Yeah, before one can check your answers to be sure it's right. I think they removed those options, but it really doesn't even, it's not necessary, right? Okay, moving on. Question number 5. Oh, question number 6, sorry. Which estate objective applies to the people who remember their favorite charity upon their death and perhaps support them in a way they were not financially able to during their lifetime? Legacies, charitable giving, education from estate creation. I believe it's charitable giving. So you can, you see, make a plan or take a policy that pays to the person's charitable organization of any of their choice upon their death, right? Okay. Next, question 7. Which one is most devastating financial? Which one is the most devastating financial result from death of an income earner supporting a family? Ooh, to be loss of income, I believe. Debt repayment, no. Income taxes, I don't think so. Loss of caregiver, no. Loss of income, yes. All right. Which is the strategy that means that the person accepts the fact that he is exposed to the risk and will accept the consequences if the risk is realized? Okay, you remember, right? So I think there was an opposite of this question was asked earlier, question 1 or 2 or so. Is it risk avoidance? No. Risk reduction? No. Risk transfer? No. It's risk retention. It's a risk strategy that means the person accepts that he is exposed to the risk and will accept the consequences. It's risk retention, that is, you choose to keep the risk with your risk, right? All right, question 9. Which term refers to average number of years that the person within a certain group and of a certain age expect to live from that age forward? Okay, life expectancy, birth rate, no. Probability of death, no. Mortality rate, I believe it's life expectancy. Look at what it's asked here. Average number of years a person within a certain group of a certain age is expected to live from that age forward, life expectancy. Question number 10, and then there will be a moment of truth, okay? If it is not possible to avoid a risk entirely, what is the action to take to reduce the probability of severity of the risk? Is to transfer it now. If it's not possible to avoid it, to reduce the impact of the severity, risk reduction, no, risk avoidance, no, risk transfer, yes. All right, finish attempt. And it will tell you that you see, this is the page you check. If you see that it doesn't save your answers, it means it wasn't attempted. So you go back and redo it, or if there's anyone you want to. And on this side, you see the ones you've completed. All right? It's time to submit. Okay, let's submit. Submit and finish. Hey, okay. I told you guys I don't know everything. Though. Question number 3. Let's see. Uh-oh. What liability arises upon death that can seriously erode an estate? Wow. Say the correct answer is income taxes. Really? What is the rationale? The rationale is that the income tax liabilities that arises upon death can seriously erode. Oh, okay. I got it. You got it? Okay. And then, question 10. We missed it. Uh-oh. Let's see. I thought it's risk transfer. No, they say it's risk reduction. Really? This thing can be tricky. I was so confident that it's risk transfer. Your answer is incorrect. Correct answer is risk reduction rationale. If it is not possible to avoid a risk entirely, it may be possible to take action to reduce the probability or severity of the risk. This is called risk reduction. Okay, so could it be entirely here that because, wow, it's interesting. Anyways, there you have it. All right, this is quiz by quiz question for chapter 1. Okay, let's go on to chapter 2. Going back. Uh-oh. I don't want to go all the way, so life insurance, quiz by quiz, chapter 2. All right. Okay, so we have question number 1. Which policy offers a level debt benefit? Option A, increasing term benefit. No. Debt benefit? Come on. Level term and decreasing term. Oh, sorry, increasing term, death benefit, level term. This which policy offers a level death benefit. So it's a level term. Okay. Awesome. Let's move to the next. So this chapter, we are having 15 questions to answer. Taking a sip of my coffee. Question number 2. Term insurance is pure insurance, meaning that its value relates solely to the benefit that is paid out upon death. The premiums are simply combination of the mortality cost experienced by the insurance company and which of the following. Okay. Option A pure life insurance, long-term premium, expenses, and profit. So what this question is asking us is that a term life insurance is pure insurance. Of course, we know that because it does not accumulate any death benefits, all right? Now, meaning that its value relates solely to the benefit that is paid out upon death. Yes. So its value is only the amount paid out upon death, which is the death benefit, right? Awesome. The premiums are simply a combination of the mortality cost experienced by the insurance company. Remember, we discussed this. And then which of the following? So is it option A, pure life insurance? No. Long-term premium for option B? No. Expenses? Yes. So the cost, the premium that somebody pays for term insurance, okay, is a combination of the mortality cost experienced by the insurance company and the expenses. Remember when we're talking about it, I did mention part of the expenses is even how we, the brokers, are being paid, if you remember. Anyways, and definitely not profits, okay? All right, question number 3 is, on the following list, when is recommended to obtain a renewable term policy? When there is or are of the following list, my eye is not at its best this morning, so bear with me. I've put my eye drop, but still, let me take another sip of coffee. All right. Of the following list, when is it recommended to obtain a renewable term policy? Out of the following list, that's what they're asking. Where do you think is the best to get a renewable term policy? Option A, short-term risk. Option B, limited cash flow. Option C, decreasing risk. Option D, investment risk. When is it recommended to obtain a renewable term policy? First of all, what is renewable term policy? A renewable term policy is a temporary insurance that you take and that have a feature that you can renew it upon certain timeline as stated in the contract, okay? So when is it advisable to go with that renewable option term policy? Is it when there is a short-term risk? If the risk is so short-term, there's no need to have a policy that you have to renew, right? When you have limited cash flow, is it when your risk is decreasing, like mortgage, or for investment purposes? Term insurance doesn't accumulate investment fund, so it can be for investment. This is a very tricky question. I don't think it can be for investment. I don't think either for short-term risk. If your risk is short-term, then there's no need for you to renew, right? And I'm not sure. So I'm going to go with limited cash flow, because when you don't have enough cash flow to do something permanent, having a renewable policy, which is cheaper than something permanent, might give you the opportunity to renew on an ongoing basis within your budget, right? So again, we'll see at the end, right? I don't know everything. Okay. It's my hope that all this effort will help you. Okay. Question number 4. Which of the following is a good reason to obtain term insurance with regards to a covering, a debt? Which of the following is a good reason to obtain term insurance with regards to a covering of a debt? A, investment purposes. Again, I don't see how term insurance will help us, right? Long-term risk, limited cash flow, decreasing risk. Wow. Which of the following is a good reason to obtain term insurance with regards to a covering of debt? Decreasing risk, limited cash flow, long-term risk. Is a good reason to obtain temporary insurance with regards to covering a debt. You want to use this policy to cover a debt. Maybe you owe it. Yeah, remember that example that we had, I believe it was in chapter 2, that the guy borrowed 100K from his dad, and then he took life insurance of them for 5 years for that 100,000 in the event that he passes away before the 5 years to pay his dad. So that term insurance there was to pay off his father's the money he's owing his father. Okay. Now, which is a good reason? Well, is it for investment purpose? Is it for long-term risk? Is it for limited cash flow? Or is it for reducing risk? It's for reducing risk. Because in the case of that gentleman, he was trying to long-term risk, decreasing risk. Long-term risk. Is it long-term risk? That is a decreasing risk. To be honest with you guys, I'm not exactly sure, but I'm going to go with my guts. Initially I was thinking decreasing risk. However, which of the following is a good reason to obtain term insurance with regards to a covering in death? Which of the following is a good reason? Is it to decreasing risk, limited cash flow, long-term risk, investment purposes? Long-term risk. You see, I was going to go with decreasing risk, and I also looked at long-term risk. It can't be long-term risk. This is a term insurance. It's a good reason to obtain a term insurance with regards to a covering of debt. So if they had said a good reason to get term insurance, I would have said limited cash flow. But this second, the last statement here that says, with regards, this last sentence that says, with regards to a covering a death. So that's why I'm thinking decreasing risk, right? It can be investments, it can be limited cash flow. Okay, so like I said, I'm going to go with my gut here, okay? We'll see at the end. But one thing I love about the exercise we just went through together is the way you can read the questions, tear them apart, put it back together, look at the options. Yes, that's what you want to do. But again, you want to do that on a very, very fast pace, because on the real exams, you don't have unlimited time at your hands, right? Okay, let's move on forward. Question 5. Weight is not an advantage of term life insurance. Okay, which one is not advantage? Now, also put the note for you in bold. So in other words, they are looking for the wrong one. That is what it's not. So be careful when you see what not. Okay, we are looking for the word that is not an advantage of term life insurance. Option A, renewable and convertible provision. Option B, premiums are guaranteed over term. Yes. Renewable and convertible provision, that's a good, is a good advantage of term insurance. Term of coverage can be customized. Yes. Amount of the policy covered at the end of the amount of the policy coverage at the end of term. So what does that mean? Amount. Which of the four is not an advantage of term insurance? Amount of the policy coverage at the end. I'm not making sense of that right now. So we are looking for which is not an advantage of term life insurance. Renewable and convertible provision is an advantage because if the individual develops sickness during the term, that individual can renew and convert that policy. So it's an advantage. Premiums are guaranteed over the term. Yes, your premium doesn't go up. It stays the same over the term, which is an advantage. Term coverage can be customized. Oh, yeah. Term coverage cannot be customized though. It's what it is, right? It's a bare bone kind of, right? Yeah. You see? I hope this is right. Now, amount of the policy coverage at the end of the term. Yes, I think that's correct too, because term coverage only pays out if the risk is realized, right? Anyways, mark it. Question number 5. I'm marking it. Let's see. All right, question number 6. Which premium on renewal may vary? Which premium on renewal may vary? Okay, renewal provisions, term insurance, non-renewable, re-entry. All right, let's take a look again. Which premium on renewal may vary? You know, we've seen that term insurance premium remains the same all through the entire period of the term, right? So which premium upon renewal may vary? Renewal provisions, term insurance, non-renewable, re-entry. I think it's term insurance. You see, term insurance upon renewal, premium may vary because you're renewing the attained age, right? Yeah. Renewal provisions depends on the contract, because if the renewal provisions states the premium from the onset, then it's already there, right? Then term insurance upon renewal, definitely premium will definitely vary. Non-renewable, well, you're not renewing, so there's nothing to re-entry. Re-entry comes up when, re-entry. Yes, I think it's re-entry. Oh my goodness, I think it's re-entry. You see, re-entry is, the kind of term insurance that put into consideration the experience of the insurance company. Remember, we discussed it, right? So if the experience of the insurance company is better than projected, then premiums go down. If it's as projected, then premiums may stay the same. But if it's worse than projected, then premium will go up. So re-entry, yeah, which premium on renewal may vary, yeah. Okay. You see? Ooh, wow, interesting stuff. Mark that again, question number 6. Wow. All right. I hope you're learning something from this process. Okay, I think this is the whole idea of this, right? I'm just like any of you. Okay, the fact that I'm doing the class doesn't mean I know everything. But if you take your time, you calm down, you go through this process, you're going to be just fine. Okay? Now, chapter 7. On a person's policy basis, on a per policy basis, which of the following is estimated by estimated by multiplying the policy's face amount by the life insurance probability of death during the year? I remember this. We talked about this. Yes, the that multiplication. Pure life insurance, mortality cost, expenses, long-term premiums. I think it's long-term premiums. I remember this. You see, on a per policy basis. That's where we're talking about the model of payment. Yeah, we talked about this, and we talked about the fact that if you are paying on a monthly basis, your premium is going to be slightly higher than somebody that is paying annually, right? Or biannually or quarterly, right? So it says on a per policy basis, which of the following is estimated by multiplying the policy's face amount by the life insurance probability of death during the year? Yeah. So it's not pure life insurance, no. Mortality costs. expenses, long-term premium. Okay, I'm going to go with that, but again, we'll see. Okay. Question 8. Which clause states that the insurance company will not pay the death benefit if the life insured commits suicide within a specified period of time? Well, this is a direct one. We're not going to waste time here. Okay. Is the original age? No. Suicide exclusion? Yes. Incontestability or attained age? You see, all these are principles on their own. Okay. Original age, attained age, incontestability period, and suicide exclusion. Okay. All right. Next, question 9. What is most often used by people who have mortgages? Who have mortgages? What do they use? Is it their benefit? No. Increasing term? No. Level term? No. Decreasing term. You see, decreasing term benefit is the most suitable temporary insurance for mortgages. Most people use it. I don't want to use the word the most suitable. No. Most people, that's why when you go to the bank and you take their mortgage insurance from the bank, it's not the best, but that is the most. That's what the bank have, and they push it on everybody, right? Do you want me to explain decreasing and level and increasing all this for you? Leave it in the comment section, okay? Moving on. Question number 10. What is the amount that the insurance company will pay if the life insured dies? Ah, you can please close our eyes and answer this question. We can answer this with our eyes closed. Of course, it's death benefit. That is what the insurance company pays, okay? It's not decreasing term, increasing, nah. Right? Don't let them bamboozle you. All right? All right. If you don't know any of these principles, okay, watch, and it's most likely you have not watched the training video for chapter 1 and chapter 2. Okay, I have it already. Please go watch it. Okay. Now, which mandatory limitation? Oh, look at that one. Mandatory limitation only has 2 years after its issue the policy to avoid the policy if it is discovered an error in a material fact. What am I reading? Okay, let's do this again. Which mandatory limitation only has 2 years after its issue? The policy to after its issue, the policy to avoid the policy to avoid the policy if it discovers an error in the material fact in the application. Is it suicide provision? No. Attain age? No. Incontestability. It's incontestability. See, there's what we call contestability period. Okay. Contestability period is a period after which there's nothing, the insurance company cannot cancel that policy again, claiming the final company can no. It's not gonna happen. Next. Ooh. Question 12. Which contract usually terminates upon the death of the first person to die? Even the answer is there, the first person to die. It's joint first to die. It's not single life, it's not joint last to die, it's joint first to die. He's even writing a question. Oh. Okay. Question 13. Which term policy has higher premiums or even been denied coverage if the policyholder's health has deteriorated? Ooh. Which term policy risk higher premiums or even being denied if the policyholder's health has deteriorated? Non-renewable, renewable, re-entry, guarantee renewable. Mm, 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 mm. Eh, eh. Look, non-renewable, you can't even renew, so forget about it. Renewable, once you have renewable term policy, you're guaranteed to renew, whether the health deteriorated. Guarantee renewal, I think it's re-entry. No. Which policy risks the higher premium or even being denied coverage if the policyholder's health has deteriorated? It's not guaranteed renewable, that's for sure, because you're guaranteed you'll be renewed. Re-entry, yes, you risk higher premium. Yeah, I think I'll go with re-entry. Okay, again, don't worry, we are 2 questions away from moment of truth. Okay, most policies provide a guaranteed schedule of dash when the policy is first issued. A guaranteed schedule of renewal rates, non-renewal rates, re-entry term with adjustable rate, renewal provisions. I would say renewal rates. Most term insurance provide you with renewal rates. But the thing is, many people don't look at those renewal rates. They just look at, okay, today. No, when you have illustration, go down, especially with term insurance. You will see the you will see the renewal, but it's not always that. Anyways, I might be wrong, but so let me know when policy is fair agent, renewal rates, non-renewal rates, re-entry with adjustable rates, no rate. Oh, it's renewable provisions. Most policy provide guaranteed schedule of renewable provisions. Yeah. Renewable provisions, that is the options to renew all those provisions, renewable provisions. Okay, let's see. One question from moment of truth. Okay. Which renewable policy can be subject to 2 different renewal rate schedules? Which renewable policy can be subject to 2 different renewal rate schedules? Re-entry term with adjustable rates. Renewal provisions, no. Renewable with guaranteed rates. Which renewable policy? That is, we have a renewable policy, is the policy that has a provision that you can renew. For example, if you take temporary insurance for 10 years, after the 10 years, you can renew. So they're asking us which renewable policy can be subject to 2 different renewal rate schedule. Okay, which renewable, okay? Renewable with guaranteed rates can be subject to 2 different renewal rates. Renewal rates. Re-entry term, okay, with adjustable rate. I'm gonna go with it because re-entry term, okay, no renewable. Re-entry terms is the term insurance that have provision for your term insurance to be readjusted. Remember, I explained it earlier that nothing is cast on stone. Let's say if the contract says after 5 years, there's going to be a review. So if the insurance company does better than projected, your premium could go down. If their projection stays the same, your premium stays the same. If their estimate, and they did not good, your premiums could go up. Okay? So re-entry, that is re-entry term. And then if you now have that could give you a different thing. And then the second layer to it is when you now have this re-entry term with adjustable rate. So that would now make you two different renewable rate schedule. So that's why I want to go with this. But again, we are adding fine. So moment of truth is here. We don't need to overflow this. Okay, so we see all our answers are saved. Submit and finish. Final questions. To be sure you ready, submit. But C0 Kundo, we fell 6. This life insurance is but again. All right, so let's go back and review it. And it's even good it's happening like this because now you can see and then go back and then you get it right. By the time you go through this, all the explanation is even good because if I score everything good, how will I explain it? And how will you now get it right when it's your own turn to do yours? So, which policy offers a level death benefit? We say level death, that is correct, and look at it. The majority of term life insurance policies offer a level death benefit, meaning that the death benefit equals the initial face amount, regardless of when the life insured dies during the term coverage. So that's a very straightforward one. And then question number 2, we happen to get this one also, right? So it said term insurance is pure insurance, meaning that its value relates to solely the death benefits that is paid upon the death of the life insured. So the premiums are simply a combination of mortality cost experienced by the insurance company and then which of the following. This is a question, and the expenses. And here is the rationale. The rationale states that, you see, I'm reading this rationale so that we all can piggyback on it, even though we got the answer correct. The premiums also have to cover the insurance company's expenses, including the cost of selling the policy. That is for marketing, salary, or commissions to the agent. Remember, I mentioned that. On the right, and then also the cost of underwriting the policies as well, right? So issuing and administering the policy, investigating claims, paying their benefit, and all those kind of things. These are all the expenses that an insurance company will have to make provisions for. Question 3, we didn't get this though. The question says, of the following list, when is it recommended to obtain a renewable term policy? And see, our question is, they said the short-term risk. Oh, okay. The rationale is that term insurance is particularly suited for a short-term risk or non-duration if there is a possibility that the risk will extend beyond the anticipated duration, then the policyholder should choose a renewable policy. Okay. Short-term risk. Awesome. Okay, question 4. We got this one. All right. Which of the following is a good reason to obtain term insurance with regards to covering a debt? Well, a decreasing risk, okay? And the rationale is that term insurance may be very suited for covering risk that diminishes over time, such as mortgages or other loans that are repaid over a known amortization period. Okay. Question 5. I will ask you guys to note this one down because, yeah, which is not an advantage of term insurance. They say that the correct answer is what? The correct answer. Policy is worthless at the end of the term. So what are they saying in essence? I don't understand. Rationale. Policy is worthless at the end of the term as coverage ends. So is that what this thing means? Amount of policy coverage at the end of the term. Yes. Oh my God. Anyways, what's it? The answer here, they say is D, which I agree because if the risk does not happen during the period, the policy is worthless. But they could have worded this answer better for better understanding. Anyways, it's what it is. And I struggled with this, if you guys remember, right? Uh-huh. Question 6, which premium on renewal may vary? I say re-entry, but they say no. Oh, the correct answer is renewal provision. Really? Oh, why? The rationale is the premiums upon renewal may vary depending upon the policy's provision. On renewal may vary. So it's renewal provision, term insurance, non-renewable, re-entry. Interesting. Okay, question 7. Again, we didn't get this one. On a per policy, which of the following is estimated? Really? Which of the following policy is estimated by multiplying the policy's face amount by the life insurance probability of death during the year? Is mortality cost. Interesting. Oh, and the rationale is on a per policy basis, the annual mortality cost is estimated by multiplying the policy's face amount by the life insured probability of dying during the year. Okay. Yeah, even that I should have. Okay. Anyways, you got it right. Question 8, we got that one, is suicide exclusion. Okay. And the rationale is that insurance contracts also usually include a suicide exclusion clause, which states that the insurance company will not pay the death benefit if the life insured commits suicide within a specified period of time, typically 2 years after the contract was issued. So if the contract was issued in 2023, the suicide exclusion starts from 2023 and 2024. So if the individual commits suicide within this period, the policy would not pay. For anything after 2 years, the policy will pay. And that's what we call suicide exclusion. And question 9, we got this one. It says, which most often used for people who have mortgages is decreasing term insurance. And the rationale is that insurance is most often used by people who have mortgages because of the amount at risk. The outstanding mortgages decreases over time. So as their mortgages decreases, then the amount that decreases. Okay. Question number 10, we also got this one. And the question is, you see, the reason why I'm reading the question again is so that we see the rationale, because when you read the rationale, you're understanding the concept even more. Because for some of you, I know is your first rodeo, you're doing this for the first time, and it's my goal to make it easy for you as much as possible. So while we're on this, please kindly subscribe. Okay, that's your way of saying, Joy, thank you for putting effort into this for me to have these resources. And if you feel these resources is helpful for you, leave a comment in the comment section. How has it helped you? And how will you recommend? Because some people, your comment in the comment section will help some people to even put more attention to this. Okay? All right. So now we see question 10 said, what is Okay, what is the amount paid upon that is called death benefit now? And the rationale is that the death benefit is the amount that the insurance company will pay if the life insured dies while the policy is in force. Yeah. Question 11, yeah, we got this too. Which mandatory limitation only has 2 years after its issue of the policy? Again, this one is incontestability. See, we have suicide exclusion. We read that one. So now you know. Now you know what suicide exclusion is. If you don't get it, don't forget about it. Please rewind. Okay? Now, incontestability. Now, reading this rationale will also make you understand incontestability period. You see, under the rationale, say, under the mandatory incontestability limitation, an insurance company only has 2 years after it issues the policy to void the policy if it discovers an error in a material fact in the application. So they only have 2 years. After 2 years, they can come back to say nothing. All right, moving on, question 12. We also got this one, guys. You see, we are not doing bad after all. All right, I'm just saying this to make you like feel relaxed and all that. All right, which contract usually terminates upon the death of the first person of the first to die? Right? The rationale is that the first to die contract usually terminates upon the death of the first person to die. Yeah. Okay. Question 13. We didn't get this one. So let's read it carefully and let's get what we did not get before. Which term policy raise higher premium? Or even being denied coverage if the policy owner's health has deteriorated? We go with re-entry. They say no. The answer is non-renewable. Really? Why now? Okay. All right, let's read the rationale. They say with a non-renewable term insurance policy, the policy expires at the end of the term, and the policyholder has to apply for new life insurance if he requires continued coverage. If the health of the life insured has deteriorated, the policyholder risks higher premiums or even being denied coverage. That is true. So now you got it. It's a non-renewable. Okay, guys? Question 14, we didn't get it too. Let's read it together. Most policies provide a guaranteed schedule of dash when the policy is first issued. We went with renewable. But the correct answer is renewable rate. Oh my God. Oh. So what is happening here is that renewable provision is not even an option. Okay, most policy provide a guaranteed schedule of renewable rates. When you say schedule, okay, a guaranteed policy schedule. It has to be rate now. Provision cannot be a schedule now. Oh, wow. Anyways, when the policy is first issued. Okay, question 15, we got that one. Okay, which renewable policy can be subject to the oh, and you look at the rationale, got this oriented term with adjustable rates. Okay. Some insurance companies offers a re-entry insurance, which essentially is a renewable policy that can be subject to two different renewal rate schedules, a guaranteed renewal rate and a lower rate that is adjusted for a good health of the life insured. Oh, okay. So yeah, as I was saying, we've done chapter by chapter quizzes for chapter 1 and chapter 2. I'm going to stop the class for now because chapter 1 and chapter 2 training materials are together. So it makes sense that chapter by chapter quiz for chapter 1 and chapter 2 is together. The way, because chapter 3 is separate, I'm not going to lump chapter by chapter quizzes for chapter 3 in this class. So here is where we're going to draw the curtain, and I will see you in the next class. Thank you very much.